Warren Buffett's Berkshire Hathaway just revealed two massive moves that hint at a potential market crash ahead. After analyzing their latest quarterly report and digging through historical data, I found something remarkable. Buffett's sitting on $325 billion in cash, the highest cash position ever, while simultaneously dumping huge portions of his biggest stock holdings. In this video, I'll break down exactly what Buffett's doing with his money, why he might be preparing for a market downturn, and what this means for your investment strategy. After spending 3 days analyzing these numbers, here's what you need to know. Let's look at Buffett's biggest move first. Berkshire just sold another huge chunk of Apple stock, their largest position ever. In just the last quarter, they dumped Apple shares worth $14 billion. To put this in perspective, Berkshire's Apple stake has dropped from $178 billion to just $70 billion since last year. Here's what's interesting, though. Despite Buffett selling such massive amounts, Apple's stock price actually went up during this period. This tells us other investors are eagerly buying what Buffett's selling, which makes his decision to exit even more intriguing. Berkshire was Apple's largest shareholder, and scaling back this dramatically is a major shift in strategy. Now, here's where things get really interesting. All that money from selling Apple? Buffett isn't reinvesting it. Instead, Berkshire's sitting on a mind-blowing $325 billion in cash right now. Let me put that number in perspective for you. This cash pile alone is worth more than most Fortune 500 companies. It's bigger than Bank of America, Walmart, or MasterCard's entire market value. Think about that. Buffett's cash position alone could buy most of America's largest companies outright. And instead of deploying this mountain of money into stocks or acquisitions, he's keeping it in short-term treasury bills, earning about 4.5% interest. That's roughly $14 billion a year just in interest. But for Warren Buffett to accept such modest returns, something bigger must be on his mind. This massive cash hoarding becomes even more telling when you compare it to what other major players are doing. Take the big tech companies, for example. They also had huge cash reserves last year, but they've found ways to spend it. Microsoft, Google, and Meta are pouring billions into AI infrastructure, buying up NVIDIA chips, and building data centers. Even Apple's spending big on AI and VR tech. But Buffett, he's doing the exact opposite. While everyone else is going all in on new investments, he's systematically pulling back and stockpiling cash. When one of history's most successful investors moves against the crowd like this, it's usually worth paying attention. What does he see that others might be missing? Here's what makes this situation even more unusual. Berkshire didn't buy back a single share of its own stock last quarter. Not one. This is a big deal because Buffett has always said he'll buy back Berkshire shares whenever they're undervalued. He's even chosen buybacks over paying dividends, arguing it's better for shareholders. But now, for the first time in years, he's completely stopped buybacks. So let's be clear about what this means. Buffett isn't finding stocks worth buying, isn't buying his own company's shares, and is holding more cash than ever before. It's starting to look like he's preparing for something big. Warren Buffett has historically been incredibly strategic with his timing, and his recent moves raise some big questions. Back in May at Berkshire's annual meeting, Buffett mentioned concerns about potential increases in capital gains taxes. By selling now, he could be positioning Berkshire to pay lower taxes on these massive gains before any tax hikes kick in. But there might be something bigger at play here. The systematic selling of major positions like Apple, combined with stockpiling an unprecedented amount of cash, suggests Buffett could be preparing for a significant market downturn. Remember, Buffett's famous quote is to be fearful when others are greedy. With markets near all-time highs and Berkshire sitting on $325 billion in cash, he appears to be following his own advice. While Buffett himself has always said he can't predict market crashes, his actions speak volumes. He's reducing risk across Berkshire's portfolio at a time when many investors are still piling into stocks. For a legendary investor who made his fortune by being patient and striking when others panic, this massive cash position could be dry powder for future opportunities. Just remember, Buffett's timeline for deploying capital is usually measured in years, not days or weeks. Let's look at something fascinating about Berkshire's performance. While many critics say Buffett has lost his touch, the numbers tell a different story. When we compare Berkshire to the S&P 500 recently, they're neck and neck in terms of returns. Here's why this is actually incredible. Berkshire is achieving these similar returns while keeping 1/3 of its assets in cash. Think about that for a second. Most index investors are fully exposed to market risk, but Berkshire is matching their performance while keeping a massive safety cushion. It's like running a race while carrying a parachute and still keeping up with the leaders. This isn't the astronomical outperformance Buffett achieved in his early years, but it's impressive in a different way. This means Berkshire investors are getting S&P-like returns with significantly less risk. While Buffett may not be hitting home runs like he used to, he's consistently getting on base while playing excellent defense. In today's market environment, that's a strategy worth paying attention to. Here's what makes Berkshire's position so powerful right now. With nearly $1 trillion in market value and $325 billion in cash, they're perfectly positioned to capitalize on any market downturn. Think of it this way. If stocks drop 20% or 30%, most investors will be nursing losses. But Berkshire? They'll be shopping for bargains with their massive cash pile. This defensive strategy means Berkshire shareholders get the best of both worlds. They participate in market gains through Berkshire's existing investments while having built-in protection from their huge cash position. It's like having insurance and investment returns wrapped into one package. Speaking of smart defensive plays, I recently did a deep dive into why Berkshire Hathaway is actually one of the 3 stocks I'll never sell from my portfolio. If you're interested in why I'm so confident about holding Berkshire long-term, plus 2 other powerhouse companies with incredible business models, check out my video right here. I break down exactly how these companies make money in ways most investors don't understand, and why they're perfect for building lasting wealth. You might be surprised by the real estate empire hiding inside one of these companies. It's not what most people think.